In this video, learn how elite proprietary traders are taking fewer trades with more size and risk and achieving even larger profits.
Hi, I'm Mike Bellafiore, co-founder of SME Capital, and we're a proprietary trading firm located in Midtown Manhattan. And I'm also the author of the trading classic, One Good Trade, and the Playbook. Click our subscribe button so you don't miss any of the videos that we're producing for you in the trading community.
Learn how you can trade less and why you should focus on trading less to help grow your trading account.
So this was a day one fresh news setup in Apple. There's also a market relative weakness setup using the overall market big picture. So today, the big picture of the overall market, the SPY had put in a low 15 days ago and rallied 30% since. At that low, volatility peaked at 85. Now volatility was trading at 40s. So the market was still in play, but not nearly as in play as it was back when we were at the peak. The daily volume for SPY also had dropped off 40% in a matter of the last 3 weeks. And so things have slowed down, but are still we're still in a market in play environment. So with that, compared to March especially, my focus points in April have become to really focus on stock selection, focus on only the strongest and weakest day ones and day twos, really making sure that I identify what setup I'm taking rather than taking a breakout trades or scalp trades. That's been helping me a lot. Using more risk per trade, at least 25% of my daily stop. That helps encourage me to be more selective. With regards to execution, what I have been working on.
So
Yep.
what are you doing to find the strongest and weakest stocks for day one?
So for day one, I am both scanning through all the emails from we get emails from Spence Tobias and a bunch of Hammerstone emails in our inbox in the morning. And then I'm comparing those emails to the pre-market volume with a pre-market scanner that I have built. And what I want to see is A, a compelling catalyst, and then B, a lot of pre-market volume alongside that.
And then how are you finding the strongest and weakest day twos?
So day twos, I have a day two relative strength, relative weakness scanner that tells me all the stocks that closed at the top or bottom 25% of their range with more than 1.5 times their average daily volume. And it's sorted by the stocks that have done the most volume at the top, and then the lesser volume down at the bottom. And so what I want to see for day twos are stocks that are in the top 5 or top 10 of that filter. And those will be my day two ideas for the next day. So I look at my filter the day before, and I create my watch list for day twos the next day based on that, the top names on that list. Yeah. So for execution, something I'm working on is entering when I see a turn, allocating like a quarter of that trade's allocated risk against that turn. And that's before I've gotten confirmation that the trade has broken down and has started to work. And then when I see the breakdown or the breakup and the high volume coming into my trade in my direction through a critical level, that's when I want to enter the full 100% of my allocated risk on that setup. Also, this market, I feel like it's been very important to fight for good prices and not chase, and be still move to move. It hasn't made sense for me to hold more than 25% of a position as a core unless the stock I'm in is making new 52-week highs or 52-week lows on a catalyst. That's kind of the only exception. Otherwise, I'm trying to be very move to move. On this day here's a high time frame chart of the VIX. You can see in about 27 days, VIX ran up substantially all the way up to a high of 85. And over the next 30 days, we've come off 50%. And so while the market remains in play with volatility being above 20 or so, we are in a substantially less volatile market than in March, and that requires far more selectivity. Here's a high time frame chart of this.
It was interesting. I was reading Shark's daily playbook yesterday, and I tweeted about this today, and we put it up on our Instagram. And he was saying to trade less, but trade bigger. in this market, we're cognizant of the decline in volatility, and we're making adjustments from where we are at the top. And you're doing a nice job of recognizing the drop in volatility, though still high. Though still high, right? We'll take it.
Yep.
But we're making adjustments. So good to notice that.
Yeah, agreed. I think that's been pretty critical. Whereas in March, I think you could be a lot more fluid in this market. You're punished a lot more for taking lesser quality trades. And so you really have to be focused on A+ setups that you allocate more risk towards. SPY, you can see, is in kind of a weird spot because it fell 35% from the highs, but in the last 15 sessions, it's rallied 30% to the upside. And so we're not necessarily oversold anymore, but we're also not really overbought either because we're still below the 200 DMA. And so in this area, I'm really expecting a two-way tape. Each day may be different. We may be having a strong tape day followed by a weak tape day. And I feel like in this market, more so in any other market that I've been in the last year, it's so important to be cognizant of what the SPY is doing and what the ETF and sector that you're trading is also doing, so that you can trade with that momentum.
If you want to learn 3 real-world setups that our traders use, including the simple setup that we teach all of our new traders and the setup that turned one of our traders into a 7-figure big money earner, check out the free webinar that we're currently running. Just go ahead and click the link that should be appearing right now at the top right-hand corner of your screen. That's going to open up this free registration page in the new window. So don't worry, you're not going to lose this video. You're going to learn more in a couple of hours from this trading workshop than from years of online education.
So the overall fundamentals on this day were that the U.S. stock futures were surging overnight on the release of both promising preliminary data from a remdesivir study and also new announcement from the president in his afternoon press conference that the U.S. will be instituting a 3-phase plan to open up the country. And so this caused the Dow to be, when I woke up that morning, it was set to open 3.5% higher, and most market stocks were gapping up with it. Now, what was interesting to me was that the Qs were only gapping up 1% that morning. That gave me a clue that technology may be weaker than the overall market today. One thing I wanted to throw in was that I didn't want to be too biased on this morning that we were going to continue upwards because we're in such a high volatility market. I think it's really tricky to just blindly trust a catalyst like that. And so for me, I wanted to be very cognizant of whether the market would be showing me weakness on the open or showing me strength on the open. And if it was showing weakness, I wanted to go to my best weak stock idea. And if it was showing strength that it wanted to continue upward, I wanted to go to my best strong market stock idea. And so I included a quote from Brian Shannon, wrote a really great book. It really only price pays. You have to be very attentive to what price action is doing rather than trading a bias. So Apple on this day had another headline that was very interesting. They got downgraded at Goldman Sachs with a price target cut from 250 to 233. And the reason for that was because their modeling was showing that their demand in the next year or so was going to decline significantly. So this was seemed like a pretty major report to me from a tier 1 bank. And it caused Apple to gap down nearly 1% when the whole market was gapping up. Now on the open, Apple's RVol was very elevated. I included a picture of my RVol filter that I use in the morning that helps me see where different stocks have RVol relative to each other. So this is for all large cap stocks. And you can see here, Apple was on this list. It wasn't at the top, but the fact that it made it on this list provides me validation that this is a good stock to be trading because it's going to have a lot of volume. It's going to be very in play. And if it was not on this list, I would have been far less inclined to take the setup.
So tell us what you're trying to do there with your RVol filter.
I want to make sure that the idea that I'm trading on the open is being confirmed with a lot of volume. So on any given day, I may have 3 or 4 ideas that I want to look for to set up right. And one of the things I want to see with each of those ideas is it's doing a lot of RVol, because that shows me it's going to trade cleanly and it's going to move a lot. And so what I want to see on this RVol filter is I want to be trading a name that is in that top 20 or top 30 RVols across the entire market. And I want to use this also to help narrow my list of 3 or 4 names at the open to 1 or 2 names. That way I can make sure that I'm in the best name, because that's so important in this month's market environment.
You know what might be interesting for you to do? Like, what if you were thinking about trading something like AMD, and then you take a look at, you may already do this already. So if you do this already, I apologize. And I suspect you've thought about this perhaps. But what happens if you think about trading AMD on a particular day and you take a look at the SMH index and you start to ask yourself, and you have an idea that AMD is going to go up or down, and you start to compare AMD's RVol to the rest of the stocks in the particular SMH. Is that something you've thought about?
That is something I've thought about. So I actually was trying to do that with Apple a little bit today, or on this day. Apple, I was trying to sift through other technology stocks on the list, and the only 2 other technology stocks that I felt compared to my Apple idea that had higher RVol were Roku and Netflix on this day. So I remember on this day going through those names and trying to figure out whether I liked one of those names better than Apple. And I ended up going with Apple because it had the catalyst and the others didn't really have much reason to go down. But I think that's definitely a very interesting idea, and favoring the higher RVol name, or favoring something that has high RVol relative to the rest of its sector, I think is definitely a powerful idea. Some other stats about Apple: ATR about $11. It does a ton of average daily volume, 54 million shares, and it's a institutional stock. It's 62%.
Can I just follow up on that? So what if you compared its RVol to the other FANG names?
Right. I think that's the way to do it. I was looking at, Apple this day I know had the highest amongst the other FANG names that I could find. But I also think that there has to be a catalyst component as well. I think that it's one of many variables, but I think having the highest RVol in your sector is a very, very big check in favor if you have the idea already that something is going to move in some particular direction in this market condition in April.
Yeah, good use of technology. Good.
I think that the institutional ownership was also important, given the nature of the catalyst being a Goldman Sachs downgrade. I think institutions look at that and maybe take it more seriously than if it were a stock with less institutional ownership. So I felt more comfortable trading a downgrade on Apple than I would, say, on something with a far smaller institutional ownership like a low float. My morning game plan for today really started with the SPY, because the SPY was so in play on this day with a gap up that was 3.5%, but then came back down to being only about 2%. I had a pre-market inflection level that I really liked. It was 285.50. And my plan was that if the SPY holds above that inflection level, and ideally above VWAP, then I want to be focusing on my best strong market stock idea. And if it holds below and there's clear weakness, I want to be looking at my best weak market stock idea, which was Apple. If the SPY direction was not clear and we were going to just consolidate within this range, I wasn't too interested in playing this relative strength, relative weakness market setup in general. So that was my plan going in for SPY. Now, Apple had clear weakness. It was actually down nearly 2.5% from where the pre-market opened up. And so my plan was I wanted to look for a setup, just a standard gap down short setup on Apple if the market ended up turning weak. That starts with looking for a pop on the open, looking for that pop to turn, getting short on that turn, small risk, and then when it finally goes through open, I want to be entering my full size short against the high. That's the main scenario I was looking for. There were some other scenarios that I had in my head from prior gap down setups that I had studied. I was also open to seeing consolidate on the open and then breaking up or down. There's also a pattern where it drives upward and holds for 30 minutes to an hour and then consolidates and then breaks down. My least favorite scenario where it drives downward immediately with an opening drive and then consolidates and breaks down further. In that scenario, what I was planning to do was take smaller size on the opening drive because I'm not super comfortable with those opening drives, and then trade the pullback into VWAP or the VWAP area, try to ride the move lower.
For that opening drive to the downside, you really want a negative news catalyst that speaks to the fundamentals of the company, speaks to the core of the business. That potentially would get me a little bit more comfortable playing an opening drive right at the beginning. But my point to this is not that you should do that. My point to that is you should, in your mind, think about what you want to see to get more comfortable taking out a little bit more risk with your opening drives. And maybe that's a break of a important technical level. Maybe that's what gets you more comfortable. Maybe it is more of a fundamental news catalyst to get you more comfortable. I don't think it's true that you feel uncomfortable every single opening drive. I think if you think about it, you're more uncomfortable on the ones without a really good catalyst. Not to put words in your mouth.
No, you're right. And I think what I didn't like about the opening drive on this trade was that I wanted to see the weakness in SPY on the open first before taking Apple short. And I didn't feel like if Apple went before SPY, I didn't feel like I would have enough time to make the determination that Apple was weak enough for the short. And I also think having a level would have been helpful, because I know that in my opening drives that I have been successful with, very often it's through a level, be it like through green or through open or through a very big technical level. I think that's very often helpful for me. As far as my execution strategy, use 25% of the trade's risk on turns with tight stops against the turn high. This is a big focus for me this month. It's something that's more new to me because I'm more
So Armand, so you said this a couple times. When you say use 25% of the trade's risk on turns, when you're using the word turns, how are you defining that?
So turn, right now my definition is pretty loose. So let's say for the short, it can be like a red 1 minute or 2 minute candle. It can be also when you have like a buyer that gets taken out, like a bid that gets taken out with a lot of red prints and it's going up. That's also a turn to me. And so when I see either that price action turn or that tape turn, my goal is to short with a tight stop against that whatever high was put in. And that's something that I am trying to be resilient with, because it doesn't work all the time. And sometimes I have to try it 2 or 3 times before I finally catch it. But the risk reward when I finally do catch it is, it can be 5 to 1 or even 10 to 1.
Yeah, I would just suspect that your performance is better, and you have to measure this, when you see that turn on the tape as opposed to you see a turn on a 1 minute chart with your candles.
Yep, it is. It's more clear. It definitely is more clear when I see the buyer get taken out, or maybe there's a seller get taken out, and you can see the flood of red prints get put in, or the flood of green prints get put in. It's generally more clear when I can see it on the tape.
Breeds an open question to yourself, which is, should you be a little bit bigger? starting the turns after you see it on the tape. What we mean by that is we're watching the order flow, watching the prints. Basically we're watching where the stock is trading in real time and how that's being reported to the marketplace. And when you get good at reading the tape, there's certain indications that give you a potential signal that a move is about to occur. So stock's going up, going up, going up, going up, going up, going up. It's going up in a particular way. You notice the buying pattern, and now you notice that buying pattern disappear. Maybe you notice that buyer disappear. And that's an example of you seeing the turn on the tape. I would suspect that with your trading, having a little bit more risk on when you see things like that would be more beneficial for yourself, as opposed to it's going up, 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 it's going up. And then you're looking at your charts and you notice, oh, hey, this is a red candle here on my charts. Let me trade against that high. Not to suggest that can't be something you turn into a good trade, but I would suspect that that isn't as promising, and that doesn't deserve as much risk as the scenario I painted before. And if that's true, that's something for you to think about and potential area for you to improve.
Absolutely. Absolutely. I think using the tape, that's really the main focus. For me, I am still not entirely happy with my ability to identify the turn on the tape. I think that's really where I just need to be spending more time reviewing video and screen recording of my best trades and identifying, okay, here was a spot where I could have gotten really, really big against a really tight stop. And here's why I could have done that. Here's exactly what I saw. I think journaling that has been helpful, and I need to continue doing that as part of my routine.
I suspect that you probably can limit your trading to mostly those times when you actually do see the turn from the tape, and limit to special occasions when you do it based on the charts, and you'll do a lot better. Continue to do a lot better. And when people talk about they want to use the tape and they need to get better at those skills, there certainly are certain scenarios where you at this point can recognize when the tape has changed and when the turn is likely to have been shown to you that you can take. You don't have to necessarily worry about getting it right all the time. You just have to be considering, can you see the turn a little bit more often than you had last week, last month? Can you identify the turns you are comfortable with on the tape and taking those, the more obvious ones for you, than necessarily worrying about getting all of them right?
Absolutely. I agree. I completely agree. And then beyond the turn, for me, when I see the breakdown through my level that I'm working with the trade on heavy volume with clear selling on the tape or clear buying on the tape, that's when I need to be full risk. If I'm allocating $1,000 to the trade, that's where I need to be risk $1,000, and ideally no later, because that's usually as soon as I see that, that's my best price, and that's the price I need to take. If I hesitate in that moment, it's very easy to find yourself with a far worse entry.
Less trades, more size. Less trades, more size.
Yep. On Apple, on this setup, you can see it did one of the scenarios I was thinking of. It popped on the open and it quickly turned back to the downside, back with the pre-market trend. I didn't short here. I think I should have shorted here for that turn. My thought process was that I was watching the SPY in this moment, and I wasn't entirely sure if I wanted to be in the trade yet. But I think seeing Apple give that turn on a high RVOL what was enough for me to take that trade. Seeing that turn there, I think this was a great opportunity to enter an initial amount of risk against the turn high. And then here was the breakdown, you can't see really the volume on the volume chart just because there was so much volume on the open. But there was, when Apple got below to the open that day, it held it below it for a second, and then as soon as it started to hold below it, a big seller started coming in, and there were just big sell bricks getting thrown at the tape, and it started flashing lower and lower. So that's a clear enough signal for me to enter full risk against the high for my position that Apple is going to go lower for at least the rest of the morning session. And alongside that, SPY was also getting sold below my inflection level and below VWAP. So pairing those two variables together, that's really what made it clear to me that I need to be entering this trade. And the fact that Apple was showing that first breakdown through my open level, that was the indication that, okay, this is the moment I need to be entering full risk on this trade, at least 25% of my daily stop, because I'm seeing it. It's just super important to do that here rather than waiting for like yesterday's low or pre-market low where I'll get a bad price and the risk reward won't be nearly as good.
Question for you.
Mm-hmm.
In time, after you grow, after you get more experience, is this the type of trade where you could see yourself taking 30,000 shares and being comfortable taking that trade?
Absolutely. I think if my daily stop was big enough, I would still want to be taking 25% of whatever my daily stop is in this moment. And what I love about Apple is that I feel like I can take infinite size on this thing. It's so liquid that, I think the highest I've gotten is 1,000 and there was zero slippage. So yeah, I feel like it's very possible and I could definitely see myself getting 30,000 shares if I'm seeing all the variables align on a trade like this in a liquid name like this. That's my goal.
Less trades, more size. Good thing to be thinking about. My question's a good question for you to be thinking about to start to separate your scalps from your really good trades. It's fine to scalp around. It's fine to make cash flow scalping around. When you're thinking about building your playbook, when you're thinking about building your business, when you're thinking about, hey, what's it really going to be? What trades are going to be really worth your time as you grow? Good question to ask yourself is, when I'm bigger, stronger, better, would I take 30,000 shares on that trade? Could I do that? And if the answer is yes, then now you're on to a special trade. Now you're on to something really worth studying. Now you're on to a different type of trade. Less trades, more size. That is a way you're going to build that playbook to put together some big months.
So this was an interesting moment for Apple. It actually formed a consolidation right under the open, but above the pre-market low. And that consolidation ended up showing the exact same breakdown pattern that was shown when it broke through the open. And so this was, for me, a rare opportunity to double down on the trade. Which means in this opportunity with this breakdown, I get to tighten my stop on the trade. I no longer need to use a level above the open because we're breaking below pre-market low. I now can use a level above pre-market low. Because I'm tightening my stop, I'm now using less risk. And so on this breakdown, I get to add more size. I can nearly double up on the trade and still be just risking the exact same amount that I was risking at the open. And so that was something that I was working on in March, and that's what I did here where I have the arrow drawn. I doubled my position on this breakdown, tightened the stop, and my target became roughly a measured move from the down move that was created from the initial turn at the highs. And I think this was how I was able to make a lot on this trade using this technique.
Yeah, really good point. I tweeted about this and we did an Instagram video about this, which comes from observing the elite traders at our firm and some of the traders that I coach outside the firm, some of the best active traders are reaching new levels by taking less risk, reducing stress, lowering drawdown, which is bringing better consistency. And it seems counterintuitive, and it's against the mythologies that's out there about how you become a big trader, which tends to be hold through pain, fight the price action, increase your holding time, predict if the market's going to go up or down. I'm seeing the best active traders work actively, work intensively on reducing their stress. They're literally trying during the day, and these are some of the biggest active traders in the US. Huge P&L. You know, we're not talking green shirt level. We're talking mid seven-figure traders. Mid seven-figure a year traders, $5 million a year plus traders. They're not working on fighting the price action, stomaching pain a little bit more, increasing their holding time. They're working on reducing their stress. They're working on limiting their risk. And in doing so, guess what's happening? They're making more money. So I love that you're thinking about adding risk in a way that actually isn't causing more pain, taking on more risk, giving yourself more stress. I'm not seeing the best active traders doing any of that. I see them taking less risk, reducing their stress, lowering their drawdown, improving their consistency, and making more money.
That makes a lot of sense. So this 3-hour consolidation, a big dog consolidation, ended up forming after that breakdown from pre-market low. And so the way I executed this part of the trade was, once Apple hit that measured move target and clearly showed a high volume turn right in here, I was out my entire position because Apple had gotten nearly to the target that I was thinking of, and also because it was showing that turn against me. And so I don't want to be taking too much heat in this market. I don't want to be holding that much of a core. So I ended up getting out all of the position there and waiting for Apple to form a new setup where I could throw risk back on. So what ended up happening is it formed this consolidation, and my rule for consolidations like this, where I have a hunch that it's a continuation pattern based on it having a strong down move and then not very heavy buy volume. My idea or my rule is to look to short turns near the highs of the consolidation with, again, 25% of the setup's allocated risk. I want to be small enough to where I can try this multiple times. And then when I see the breakdown of that consolidation on volume, that's where I want to be entering full risk again against a tight stop within that consolidation. And so that's what I attempted to do here. I shorted the lower high here in this consolidation, covered some at the lows just to manage my risk, and then shorted again here at the highs. And then and again, this whole time I'm staying very small so that I can try this multiple times. I think I got stopped out on this one when it made a new high here. But then here down at the lows, when I started to see the breakdown and the volume clearly started picking up on the tape, that's where I hit the breakdown with my full risk allocated towards this position against the last lower high in the pattern. So you can see that Apple ended up breaking down again once Apple. I ended up scaling out as Apple went down, and then once it overextended at the lows and quickly reversed with another high volume turn, that's where I was out the full move. And I think it's very important to do that in this market. It's just really important not to take a lot of heat on these types of trades because the market has such a two-way tape. And so things can reverse a lot more easily. So here are my executions. This is where I doubled down on the position. An area of improvement that I'm working on these breakdown trades is not doing this where I exit kind of like every point or so. I think I can do a better job at looking for a better reason to exit and also trailing a bit better. 2 or 3 of these moments I could have actually just trailed against like the last 1 minute high or given a 25, like a small 25-cent trailer, and that would have allowed me to hold those lots for more of the full move. So that's something that I'm working on. As far as my review, I like my stock selection here because Apple was clearly relatively weak and also had volume and also had a catalyst. I think those three things were really important. My execution, I wish I shorted more on that turn because that would have on that turn on the open, because that would have allowed me to get bigger on the breakdown through the open on the same amount of risk, because my entry would just be higher. I think I should have been more aggressive in that big dot consolidation. I need to be studying those turns a little bit more and getting more comfortable with scalping in and out of those. I think that's a big goal of mine. And then as far as the exit, just trailing, that's something that I should have done on this trade. I was very quick to get out a lot of the size, and part of that was because I was somewhat uncomfortable with how many shares I had. I think it was the biggest I had been on Apple ever on this day, just because I doubled down. But in reality, my risk was still controlled. There wasn't much need to stress about my size. It was the same amount of risk as I had initially.
Hey, go ahead and click our subscribe button so you don't miss any of the videos they're producing for you in the trading community. And please take the time to add your feedback in the comments section for what videos you'd like for us to produce next and what you found helpful from this video. From all of us at S&B, train and trade well.